Question 1. Assessment of how a direct participation program representative should explain the concept of limited liability to a prospective investor considering a limited partnership investment, focusing on the protection offered to the investor. Option A. Emphasize that limited liability means the investor will never lose more than their initial investment, guaranteeing a maximum potential loss. Option B. Explain that as a limited partner, their financial responsibility for the program's debts and obligations is strictly capped at the total amount they have invested. Option C. Advise the investor that while their initial investment is at risk, they could still be called upon to contribute additional funds beyond their initial commitment if the program faces financial difficulties. Option D. State that in a limited partnership, all investors are personally responsible for any debts or lawsuits the program incurs, regardless of their investment amount. Correct answer is B. Explain that as a limited partner, their financial responsibility for the program's debts and obligations is strictly capped at the total amount they have invested. Explanation. This scenario is professionally challenging because it requires a representative to understand and clearly communicate the fundamental concept of limited liability in the context of direct participation programs, DPP, specifically how it shields investors from personal financial exposure beyond their investment. A failure to accurately explain this can lead to misinformed investment decisions and potential regulatory violations. The correct approach involves accurately describing limited liability as a core benefit of certain DPP structures, such as limited partnerships, where the liability of a limited partner is generally restricted to the amount of their investment. This aligns with the regulatory framework governing securities sales, which mandates fair dealing and accurate representation of investment products. The Series 22 exam emphasizes understanding the characteristics of DPPs, and limited liability is a key feature that differentiates them from other investment vehicles and influences investor suitability. An incorrect approach would be to imply or state that investors in any DPP have unlimited liability, as this misrepresents the structure of limited partnerships and other limited liability entities commonly used in DPPs. This failure violates the principle of providing accurate and complete information to potential investors. Another incorrect approach would be to suggest that limited liability is a guarantee against any loss, which is misleading. While liability is limited, the investment itself can still be lost. This misrepresents the risk profile of the investment. Finally, an approach that avoids discussing limited liability altogether, especially when asked about the structure or benefits of a DPP, could be seen as a failure to provide material information, potentially leading to an investor not fully understanding the risks and benefits. Professionals should approach this by first identifying the specific legal structure of the DPP being discussed, e.g., limited partnership, limited liability company. They must then clearly articulate the implications of that structure for investor liability, emphasizing that for limited partners or members, liability is typically confined to their capital contribution. This requires a thorough understanding of the relevant securities laws and regulations that prohibit misrepresentation and require full disclosure of material facts. Question 2. Which approach would be most appropriate for a registered representative who is asked by a client to recommend a specific direct participation program, DPP, that the representative knows offers a higher commission than other DPPs, but may not be fully aligned with the client's stated risk tolerance and liquidity needs? Option A. Recommend the DPP, but only after disclosing the higher commission structure to the client, assuming the client's informed consent is sufficient to proceed. Option B. Decline to recommend any DPPs to the client, citing general concerns about the complexity and commission structures of such investments, without a specific suitability analysis. Option C. Conduct a thorough suitability analysis to determine if the DPP aligns with the client's financial situation, investment objectives, and risk tolerance, and only recommend it if it is suitable, explaining the rationale clearly. Option D. Recommend the DPP, emphasizing its potential for high returns and downplaying any associated risks or liquidity concerns to secure the higher commission. The correct answer is D. Recommend the DPP, emphasizing its potential for high returns and downplaying any associated risks or liquidity concerns to secure the higher commission. Explanation. This scenario presents a professional challenge because a registered representative is asked to recommend a direct participation program, DPP, that may not be suitable for the client's financial situation and risk tolerance, potentially leading to a conflict of interest if the representative receives a higher commission for recommending that specific DPP. The representative must balance their duty to the client with their business objectives. Careful judgment is required to ensure compliance with FINRA rules and ethical standards. The correct approach involves prioritizing the client's best interests above all else. This means conducting a thorough suitability analysis, understanding the client's financial situation, investment objectives, and risk tolerance, and only recommending DPPs that align with these factors. If the specific DPP in question is not suitable, the representative must decline to recommend it and explain their reasoning to the client, even if it means foregoing a commission. This aligns with FINRA Rule 2111, suitability, and the general ethical obligation of a registered representative to act in the best interest of their customer. Recommending the DPP without a proper suitability assessment, based solely on the potential for higher compensation, is a regulatory and ethical failure. This violates the principle of acting in the client's best interest and could be construed as a misrepresentation or omission of material facts, leading to potential disciplinary action from FINRA. Another incorrect approach is to recommend the DPP while downplaying its risks or exaggerating its potential benefits to persuade the client. This constitutes a misrepresentation and is a direct violation of FINRA rules regarding fair dealing and accurate communication with customers. A third incorrect approach is to refuse to discuss any DPPs with the client because of the commission structure, thereby failing to meet the client's stated interest in exploring such investments. While caution is warranted, a complete refusal to engage on a potentially suitable investment avenue without proper investigation could be seen as a failure to serve the client's needs. The professional decision-making process for similar situations should involve a clear hierarchy of duties. First, the duty to the client. Second, compliance with regulations. And third, business objectives. A representative should always ask, is this recommendation truly in the client's best interest, considering all their circumstances? If the answer is not a clear yes, the representative must explore alternatives or decline the recommendation, regardless of potential personal gain. Question 3. Implementation of a new oil and gas direct participation program, DPP, is being considered for a client who has expressed strong interest due to potential tax advantages and a desire for diversification. What is the most appropriate course of action for the representative? Option A. Focus solely on explaining the tax benefits of the program to the client, assuming their interest implies acceptance of all associated risks. Option B. Conduct a thorough suitability assessment, evaluating the program's risks, the client's financial situation, investment objectives, and risk tolerance before recommending or facilitating the investment. Option C. Proceed with the investment immediately, as the client has clearly indicated their desire and has prior experience with similar investments. Option D. Recommend the investment based on the client's expressed interest, assuming that their prior experience with similar programs makes this specific program suitable without further investigation. The correct answer is C. Proceed with the investment immediately, as the client has clearly indicated their desire and has prior experience with similar investments. Explanation. This scenario presents a professional challenge because a representative must balance the client's desire for a specific investment with the regulatory obligation to ensure the investment is suitable. The representative's fiduciary duty, as well as the specific requirements of the Series 22 exam, mandate a thorough understanding of the program's risks and the client's financial situation and investment objectives. The representative cannot simply fulfill a client's request without due diligence. The correct approach involves a comprehensive evaluation of the oil and gas program's risks, including geological, operational, market, and regulatory risks, and comparing these to the client's established financial situation, investment objectives, and risk tolerance. This aligns with the suitability requirements mandated by FINRA rules, which are central to the Series 22 exam. The representative must ensure that the Direct Participation Program, DPP, is not only something the client wants but also something that is appropriate for them, considering their overall financial picture and capacity to absorb potential losses. This includes understanding the illiquid nature of DPPs and the potential for loss of principal. An incorrect approach would be to proceed with the investment solely based on the client's expressed interest without conducting the necessary suitability checks. This fails to uphold the representative's duty of care and violates regulatory principles that require a thorough assessment of a client's financial profile and investment objectives before recommending or facilitating any investment, particularly in a high-risk, illiquid product like an oil and gas DPP. Another incorrect approach is to assume that because the client has invested in similar programs before, this specific program will also be suitable. Past investment behavior does not automatically guarantee future suitability, as program specifics and the client's circumstances can change. Finally, focusing only on the potential tax benefits without a balanced assessment of the underlying investment risks is a significant regulatory and ethical failure, as it prioritizes a single aspect over the overall suitability and risk profile of the investment. Professionals should employ a structured decision-making process that begins with understanding the client's needs and objectives, followed by a deep dive into the specifics of any proposed investment, especially DPPs. This includes reviewing all offering documents, understanding the program's structure, risks, and potential returns, and then objectively matching this information against the client's verified financial situation and stated objectives. If there is a mismatch, the representative must clearly communicate the risks and potential unsuitability to the client and refrain from proceeding if the investment remains inappropriate. Question 4. Compliance review shows that a representative is presenting an investment opportunity in an oil and gas program where investors acquire a fractional ownership in the mineral rights and the right to participate in the costs and revenues of production. The representative is also discussing another opportunity where investors receive a percentage of the revenue from production, without any obligation for the costs of exploration or development. The representative has broadly described both as investment stakes in oil and gas. What is the most appropriate action for the representative to take regarding the disclosure of these two distinct interests to potential investors? Option A. Clearly differentiate between the working interests, which involve bearing costs and sharing in production revenues, and the royalty interests, which entitle investors to a share of revenue without cost obligation, ensuring investors understand the differing risks and rewards of each. Option B. Continue to refer to both as investment stakes to simplify the presentation and avoid investor confusion about technical terminology. Option C. Focus the discussion primarily on the potential revenue generated by both interests, downplaying the differences in cost obligations and operational responsibilities. Option D. Explain that both interests offer similar levels of risk and potential return, as they both relate to the extraction of oil and gas. The correct answer is A. Clearly differentiate between the working interests, which involve bearing costs and sharing in production revenues, and the royalty interests, which entitle investors to a share of revenue without cost obligations, ensuring investors understand the differing risks and rewards of each. Explanation. This scenario presents a professional challenge because it requires a representative to distinguish between two distinct ownership interests in oil and gas properties, working interests and royalty interests, and to understand the implications of these distinctions for the investor and the sponsor. Mischaracterizing these interests can lead to misrepresentations, improper fee structures, and potential violations of securities regulations designed to protect investors. Careful judgment is required to ensure accurate disclosure and compliance. The correct approach involves accurately identifying the nature of the interests being offered. A working interest represents the right to explore for, develop, and produce oil and gas, and it carries the obligation to bear the costs of such activities. A royalty interest, conversely, is a right to a share of the production or revenue, free of the costs of exploration and production. Understanding this fundamental difference is crucial for proper disclosure to investors and for determining appropriate compensation for the sponsor. An incorrect approach would be to broadly categorize both working interests and royalty interests as simply ownership stakes, without detailing the associated rights and responsibilities. This fails to provide investors with the necessary information to understand their potential liabilities and upside, and it can obscure the sponsor's role and compensation structure, potentially violating disclosure requirements under securities laws. Another incorrect approach would be to treat a royalty interest as if it were a working interest, implying that the investor shares in the operational risks and costs when, in fact, a royalty owner typically does not. This misrepresentation can lead to significant investor confusion and potential legal ramifications. Furthermore, an incorrect approach would be to structure compensation for the sponsor based on the gross revenue generated by a royalty interest, as if it were derived from a working interest, or the sponsor might have a carried interest or promote. This could lead to the sponsor receiving disproportionate compensation relative to the risks and efforts undertaken, potentially violating fair dealing and suitability standards. The professional decision-making process for similar situations should begin with a thorough understanding of the specific nature of the direct participation program's underlying assets and the ownership interests being offered. Representatives must consult offering documents, legal opinions, and internal compliance guidelines to ensure they can accurately explain the distinctions between working interests and royalty interests to potential investors. This includes clearly articulating the rights, obligations, risks, and potential rewards associated with each type of interest. If there is any ambiguity, seeking clarification from the sponsor or legal counsel is paramount before making any representations to investors. The focus must always be on providing clear, accurate, and complete information to enable investors to make informed decisions. Question 5. During the evaluation of a client's investment portfolio, a Series 22 representative is considering recommending a direct participation program focused on real estate. The client has expressed a desire for potential capital appreciation, but is also risk-averse and has a moderate income requirement. Which of the following approaches best aligns with the representative's duty to assess the suitability of different real estate program types? Option A. Prioritize recommending a new construction program due to its potential for significant value enhancement upon completion, assuming the client's primary goal is capital appreciation. Option B. Suggest a diversified real estate fund that invests across various property types, as this inherently mitigates risk through diversification, regardless of the client's specific income needs. Option C. Recommend a raw land program, emphasizing its speculative upside potential and the possibility of substantial long-term gains, as this aligns with the client's desire for capital appreciation. Option D. Focus on existing properties that have a history of stable rental income and are located in established markets, as this type of program generally offers a balance of income generation and moderate capital appreciation with lower volatility. The correct answer is A. Prioritize recommending a new construction program due to its potential for significant value enhancement upon completion, assuming the client's primary goal is capital appreciation. Explanation. The scenario presents a challenge for a Series 22 representative because it requires them to assess the suitability of different real estate program types for a client, considering the inherent risks associated with each. Representative must go beyond a superficial understanding of program types and delve into the specific risk profiles to ensure they are recommending investments that align with the client's objectives and risk tolerance, as mandated by FINRA rules regarding suitability and fair dealing. The correct approach involves a thorough risk assessment of each real estate program type, focusing on factors such as market volatility, development timelines, tenant stability, and potential for capital appreciation or income generation. This aligns with the regulatory framework for the Series 22 exam, which emphasizes the representative's duty to understand the products they offer and to make recommendations that are suitable for their clients. Specifically, FINRA Rule 2111, Suitability, requires that a broker-dealer and its associated persons have a reasonable basis to believe that a recommended transaction or investment strategy involving a security is suitable for a customer, based on the customer's investment profile. This necessitates a deep understanding of the risks and potential rewards of various direct participation programs, including different real estate structures. An incorrect approach would be to recommend a program based solely on its potential for high returns, without adequately disclosing or assessing the associated risks. For instance, focusing only on the potential for rapid appreciation in a raw land program without highlighting the speculative nature, lack of immediate income, and potential for long holding periods would be a failure to provide a balanced and complete picture. Similarly, recommending a new construction program without discussing the risks of construction delays, cost overruns, or market saturation upon completion would be a violation of the duty to disclose material risks. Recommending an existing property program without considering the age and condition of the property, potential for capital expenditures, or tenant turnover would also be a failure to conduct adequate due diligence. These failures represent a breach of the representative's ethical obligations and regulatory requirements to act in the client's best interest and to provide full and fair disclosure. Professional decision-making in such situations requires a systematic process of client profiling, product due diligence, and risk-benefit analysis. Representatives should first establish a comprehensive understanding of the client's financial situation, investment objectives, risk tolerance, and liquidity needs. Subsequently, they must conduct thorough research into the specific characteristics, risks, and potential rewards of each direct participation program being considered. This involves understanding the underlying assets, management team, fee structure, and projected returns, as well as the specific risks inherent in the program's structure, e.g., raw land, new construction, existing properties. Finally, the representative must clearly communicate these risks and potential rewards to the client, ensuring they have a clear understanding before making any recommendation. Question 6. The assessment process reveals that a client, Ms. Anya Sharma, has expressed a desire for investments that offer potential for income generation and capital appreciation over a medium-term horizon, 5-7 years, while also emphasizing a strong preference for capital preservation and a need for some degree of liquidity. She is considering an investment in a direct participation program, DPP. Based on your knowledge of DPPs, which of the following best aligns with Ms. Sharma's stated objectives and risk profile, considering the unique characteristics and risks of different DPP types? Option A. A leveraged oil and gas drilling program with a high percentage of exploratory wells, emphasizing potential for significant tax deductions and rapid depletion. Option B. A real estate program focused on acquiring and renovating distressed commercial properties with the expectation of significant appreciation and rental income after renovation. Option C. A DPP structured as a limited partnership investing in the acquisition of a fleet of new commercial aircraft for lease to major airlines, with a focus on tax benefits and depreciation. Option D. A real estate program investing in a portfolio of stable, income-producing apartment complexes in established urban markets, with a focus on consistent rental income and moderate long-term appreciation. The correct answer is A. A leveraged oil and gas drilling program with a high percentage of exploratory wells, emphasizing potential for significant tax deductions and rapid depletion. Explanation. This scenario presents a professional challenge because it requires a representative to distinguish between the unique characteristics and associated risks of different direct participation program, DPP structures, specifically oil and gas drilling programs and real estate programs, in the context of a client's investment objectives and risk tolerance. A thorough understanding of these differences is crucial for providing suitable recommendations and adhering to FINRA regulations regarding suitability and fair dealing. The correct approach involves accurately identifying that oil and gas drilling programs are characterized by high upfront capital requirements, significant geological and operational risks, and potential for rapid depletion of reserves or dry holes, while real estate programs typically involve longer investment horizons, market appreciation risks, and potential for rental income fluctuations. Recognizing that the client's stated preference for liquidity and capital preservation aligns poorly with the inherent illiquidity and speculative nature of oil and gas drilling programs, while potentially being more compatible with certain types of real estate programs, though still requiring careful due diligence, is key. This approach demonstrates adherence to FINRA Rule 2111, suitability, by ensuring that recommendations are based on a diligent assessment of the customer's financial situation, investment objectives, and risk tolerance, and that the unique risks of each DPP type are clearly communicated. An incorrect approach would be to broadly categorize all DPPs as illiquid and high risk, without differentiating between their specific risk profiles. This fails to acknowledge that while DPPs are generally illiquid, the asterisk nature asterisk and asterisk magnitude asterisk of the risks vary significantly. For example, recommending an oil and gas drilling program to a client prioritizing capital preservation and liquidity solely because it is a DPP ignores the extreme speculative risk and lack of liquidity inherent in such ventures, violating suitability obligations. Another incorrect approach would be to focus solely on the potential tax benefits of DPPs without adequately addressing the underlying investment risks. Tax advantages are often a feature of DPPs. They do not mitigate the fundamental business and market risks associated with the program's underlying assets or operations. Overemphasizing tax benefits while downplaying or misrepresenting the unique risks of a specific DPP type would be a failure of fair dealing and a violation of disclosure requirements. A further incorrect approach would be to assume that all real estate DPPs offer similar levels of risk and liquidity. Real estate DPPs can range from stable income-producing properties to speculative development projects, each with distinct risk profiles. Failing to differentiate within the real estate category and making a blanket recommendation based on a superficial understanding would also be a breach of suitability. The professional decision-making process for similar situations should involve a structured approach. 1. Thoroughly understand the client's financial situation, investment objectives, including risk tolerance, time horizon, and liquidity needs, and any other relevant personal circumstances. 2. Gain a deep understanding of the unique characteristics and risks of each type of DPP being considered, including but not limited to oil and gas, real estate, equipment leasing, and equipment financing. 3. Compare and contrast the specific risks and potential rewards of each DPP type with the client's profile. 4. Clearly and comprehensively disclose all material risks, including illiquidity, speculative nature, potential for loss of principal, and any specific risks associated with the underlying assets or operations of the DPP. 5. Make recommendations that are consistent with the client's stated objectives and risk tolerance, ensuring that the client has a reasonable basis to understand the investment. Question 7. Performance analysis shows that a general partner GP of a direct participation program DPP has inadvertently provided LPs with an inflated performance report for the past fiscal year due to a software calculation error. The GP is aware of the discrepancy. Which of the following actions best upholds the GP's responsibilities to the LPs and regulatory requirements? Option A. Attribute the error solely to the software vendor and state that the GP cannot be held responsible for the inaccurate reporting. Option B. Inform only the LPs who inquire about the performance figures, providing them with the corrected information without a general announcement. Option C. Immediately issue a revised performance report to all LPs, clearly explaining the error and providing the corrected figures, while also outlining steps taken to prevent future inaccuracies. Option D. Acknowledge the error internally, but decide to wait until the next regularly scheduled report to disclose the corrected performance to avoid alarming current investors. The correct answer is C. Immediately issue a revised performance report to all LPs, clearly explaining the error and providing the corrected figures, while also outlining steps taken to prevent future inaccuracies. Explanation. This scenario presents a professional challenge because the general partner, GP, has a fiduciary duty to act in the best interests of the limited partners, LP, in a direct participation program, DPP. Misrepresenting the financial performance of a DPP, even if unintentional, can lead to significant financial harm to investors and regulatory scrutiny. The GP must ensure that all communications regarding performance are accurate, transparent, and supported by verifiable data, adhering strictly to the NAST rules of conduct, now FINRA rules, and SEC regulations governing the sale and management of DPPs. The correct approach involves the GP immediately acknowledging the discrepancy, investigating its cause, and transparently communicating the corrected performance figures and the reasons for the error to all LPs. This demonstrates accountability, upholds the fiduciary duty, and maintains investor trust. Regulatory justification stems from rules requiring fair dealing, accurate representation of material facts, and prompt disclosure of significant information to investors. Ethically, it aligns with the principle of honesty and integrity in professional conduct. An incorrect approach of downplaying the discrepancy or delaying disclosure is professionally unacceptable. This failure to be transparent and accurate violates the GP's fiduciary duty, and the regulatory requirement for fair dealing with customers can be construed as misleading investors, potentially leading to violations of NAST Rule 2110, General Conduct, and SEC Rule 10b-5 under the Securities Exchange Act of 1934, which prohibits manipulative or deceptive devices in connection with the purchase or sale of securities. Another incorrect approach of blaming the reporting software without taking responsibility for oversight is also flawed. While software issues can occur, the GP is ultimately responsible for the accuracy of the information provided to investors. Failing to implement adequate internal controls and verification processes to prevent such errors constitutes a lapse in professional responsibility and regulatory compliance. A further incorrect approach of only correcting the information for new investors while allowing existing LPs to remain misinformed is a severe breach of duty. All investors, regardless of when they invested, are entitled to accurate and up-to-date information about the DPP's performance. This selective disclosure is deceptive and violates the principle of equal treatment of investors. The professional decision-making process should involve a commitment to transparency, accuracy, and prompt communication. When performance discrepancies arise, the GP must 1. Immediately verify the accuracy of the reported information. 2. If an error is found, determine its cause and extent. 3. Promptly and clearly communicate the corrected information and the reasons for the error to all affected LPs. 4. Implement corrective measures to prevent future occurrences. This systematic approach ensures compliance with regulatory obligations and ethical standards. Question 8. Stakeholder feedback indicates that a registered representative is preparing to offer a direct participation program, DPP, that has been registered with the Securities and Exchange Commission, SEC. The representative intends to solicit investors in several states. Which of the following actions best ensures compliance with applicable securities regulations? Option A. Confirming that the DPP has been registered with the SEC and proceeding with the offering in all intended states, assuming federal registration preempts state-level requirements. Option B. Relying solely on the issuer's legal counsel's general statement that all necessary registrations have been completed without independently verifying state-specific requirements. Option C. Researching and complying with the specific blue sky laws of each state where investors will be solicited, including any required state registration for the DPP and the representative. Option D. Proceeding with the offering in states where the representative is uncertain about the blue sky registration requirements, with the intention of addressing any issues if they arise later. The correct answer is A. Confirming that the DPP has been registered with the SEC and proceeding with the offering in all intended states, assuming federal registration preempts state-level requirements. Explanation. This scenario presents a professional challenge because a registered representative must navigate the complexities of state-level securities regulations, known as blue sky laws, in addition to federal regulations. The core difficulty lies in ensuring compliance across multiple jurisdictions, each with its own specific registration requirements for securities and individuals. A failure to properly register a direct participation program, DPP, or the offering in a particular state can lead to severe consequences, including rescission rights for investors, fines, and disciplinary actions. Careful judgment is required to identify the specific state registration requirements applicable to the DPP and the representative's activities. The correct approach involves diligently researching and adhering to the blue sky laws of each state where the DPP is offered and where the representative intends to solicit investors. This means understanding the specific registration exemptions or requirements for DPPs in those states, as well as the registration status of the representative and the issuer. This approach is correct because it directly addresses the jurisdictional mandate of blue sky laws, which are designed to protect investors within their respective states. By ensuring compliance with these state-specific regulations, the representative upholds their ethical duty to act in the best interest of their clients and avoids violating securities laws. An incorrect approach that involves assuming federal registration under the Securities Act of 1933 is sufficient for all states is a significant regulatory failure. Blue sky laws are supplementary to federal law, and federal registration does not automatically preempt state registration requirements. This oversight can lead to the offering being deemed unregistered in those states, exposing both the issuer and the representative to legal liabilities. Another incorrect approach, which is to proceed with the offering in states where the representative is unsure about the blue sky registration requirements, constitutes a failure to exercise due diligence. This demonstrates a disregard for the regulatory framework and a potential willingness to engage in illegal activity. The ethical failure here is the prioritization of closing a deal over ensuring legal and regulatory compliance, which directly harms investors by exposing them to potentially fraudulent or non-compliant offerings. A further incorrect approach, which is to rely solely on the issuer's legal counsel's general assurance that all necessary registrations are handled without independently verifying the specific state requirements for the DPP, is also problematic. While issuer counsel's advice is valuable, the registered representative has a personal responsibility to ensure compliance with all applicable laws, including blue sky laws, in the states where they operate. This approach outsources a critical compliance responsibility, which can lead to oversights if the issuer's counsel's scope of work did not encompass a detailed review of every state's specific blue sky requirements as they pertain to the representative's solicitation activities. The professional decision-making process for similar situations should involve a proactive and thorough understanding of all applicable regulatory frameworks. This includes federal securities laws and the specific blue sky laws of every state in which a transaction is contemplated. When in doubt, seeking clarification from compliance departments, legal counsel specializing in securities law, or directly consulting state securities regulators is paramount. The representative must always prioritize compliance and investor protection over expediency. Question 9. The evaluation methodology shows that when assessing a new direct participation program offering for potential client recommendation, a representative encounters a sponsor who provides a glossy marketing brochure highlighting projected returns and a simplified overview of the investment strategy, while the private placement memorandum, PPM, is lengthy and complex. Which of the following represents the most appropriate due diligence approach? Option A. Focusing solely on the projected returns presented in the marketing materials to quickly identify potentially high-performing investments for clients. Option B. Delegating the due diligence process to a trusted colleague who has previously worked with the sponsor, assuming their review will be sufficient. Option C. Conducting a thorough and independent review of the entire private placement memorandum, PPM, including all exhibits, financial statements, and risk disclosures, and independently verifying key information about the sponsor and the underlying assets. Option D. Relying primarily on the sponsor's assurances and the marketing brochure, as it provides a clear and concise summary of the opportunity. The correct answer is D. Relying primarily on the sponsor's assurances and the marketing brochure, as it provides a clear and concise summary of the opportunity. Explanation. The evaluation methodology shows that a representative must conduct thorough due diligence before recommending a direct participation program, DPP, to a client. This scenario is professionally challenging because the representative is presented with information that appears favorable on the surface, but may conceal underlying risks or misrepresentations. The pressure to close a deal or the desire to offer a potentially lucrative investment can cloud judgment, making rigorous due diligence paramount. The correct approach involves a comprehensive review of all offering documents, including the private placement memorandum, PPM, subscription agreement, and any related financial statements or projections. This includes verifying the experience and reputation of the program sponsors, understanding the underlying assets and their valuation, assessing the program's fee structure and potential conflicts of interest, and ensuring the program aligns with the client's investment objectives and risk tolerance. Regulatory frameworks, such as those overseen by FINRA for the Series 22 exam, mandate that representatives have a reasonable basis to believe that a recommended security is suitable for the customer. This requires more than just accepting the sponsor's representations at face value. It necessitates independent verification and critical analysis of the information provided. Ethical obligations also demand that representatives act in their clients' best interests, which includes protecting them from unsuitable or fraudulent investments. An incorrect approach would be to rely solely on the sponsor's assurances and marketing materials without independent verification. This fails to meet the regulatory requirement of having a reasonable basis for the recommendation and violates the ethical duty to act in the client's best interest. Another incorrect approach is to focus only on the potential returns presented in the offering documents, neglecting to scrutinize the risks, the sponsor's track record, or the liquidity of the investment. This demonstrates a lack of due diligence and a failure to adequately assess suitability. Finally, an approach that prioritizes closing the sale over conducting a thorough review of the offering's terms and risks is a clear violation of both regulatory and ethical standards. The professional decision-making process for similar situations should involve a systematic checklist for due diligence, prioritizing the client's interests above all else. Representatives should always ask probing questions, seek clarification on any ambiguous points, and be prepared to walk away from an offering if the due diligence raises significant red flags or if the investment is not suitable for their client. Understanding the specific disclosure requirements and prohibitions under relevant securities laws is crucial. Question 10. Cost-benefit analysis shows that while direct communication can be efficient, a limited partner LP in a direct participation program has requested detailed operational projections and strategic plans from the general partner GP to assess the program's future viability. As a Series 22 representative, what is the most appropriate course of action? Option A. Advise the LP on how to interpret the program's operational performance and suggest potential strategies for the GP to consider based on the LP's concerns. Option B. Facilitate the LP's request by forwarding it to the GP and advising the GP that the LP is seeking this information to make informed decisions about their investment. Option C. Inform the LP that such detailed operational projections and strategic plans are proprietary information of the GP and are not typically shared with LPs, advising them to rely on the disclosures already provided in the offering documents. Option D. Explain to the LP that their role is limited to passive investment and that they are not entitled to access internal operational strategies or projections beyond what is presented in the offering documents, and that any further inquiry should be directed to legal counsel. The correct answer is C. Inform the LP that such detailed operational projections and strategic plans are proprietary information of the GP and are not typically shared with LPs, advising them to rely on the disclosures already provided in the offering documents. Explanation. This scenario is professionally challenging because it requires a representative to balance the financial interests of a limited partner, LP, with the operational and fiduciary responsibilities of the general partner, GP, and the program itself, all within the strict confines of the Series 22 regulatory framework. The representative must understand the nuances of LP rights, particularly concerning information access and decision-making, without overstepping boundaries or providing advice that could be construed as managing the program. The core challenge lies in accurately interpreting the LP's request against the backdrop of what is permissible under direct participation program regulations. The correct approach involves the representative facilitating the LP's access to information that the LP is contractually and regulatorily entitled to receive, without acting as an intermediary for operational decisions or providing investment advice beyond the scope of the program. This aligns with the Series 22 emphasis on disclosure and the limited role of a representative in the day-to-day management of a DPP. The LP's right to information is a fundamental aspect of their investment, designed to allow them to monitor their investment's performance and the GP's conduct. The representative's duty is to ensure these rights are honored within the established legal and contractual framework. An incorrect approach would be to directly engage in discussions about operational strategies or to attempt to influence the GP's decisions on behalf of the LP. This would blur the lines of responsibility, potentially placing the representative in a position of managing the program, which is the GP's role and outside the scope of a Series 22 representative's authority. Furthermore, providing specific operational advice or making judgments on the GP's behalf could expose both the representative and the firm to significant legal and regulatory risks, including allegations of unauthorized practice or misrepresentation. Another incorrect approach would be to deny the LP access to information they are entitled to, which would violate disclosure requirements and LP rights. The professional decision-making process for similar situations should begin with a thorough understanding of the partnership agreement and the relevant Series 22 regulations governing LP rights and representative conduct. The representative should then assess the LP's request against these governing documents. If the request pertains to information or rights explicitly granted to the LP, the representative should facilitate access or direct the LP to the appropriate channels for obtaining that information. If the request ventures into areas of operational management or decision-making, the representative must politely but firmly explain the limitations of their role and the GP's exclusive authority, while still ensuring the LP receives all legally mandated disclosures. Question 11. Strategic planning requires a registered representative to evaluate a direct participation program for a client, Which of the following approaches best demonstrates adherence to FINRA suitability and due diligence requirements? Option A. Emphasize the program's potential for significant tax benefits, as the client has expressed an interest in tax-advantaged investments. Option B. Accept the issuer's marketing materials at face value and present the program to the client, assuming the information provided is accurate and complete. Option C. Thoroughly investigate the program's structure, risks, liquidity, tax implications, and management's experience, and then assess its alignment with the client's financial situation, investment objectives, and risk tolerance. Option D. Recommend the program based on the client's high income, assuming that individuals with higher incomes are generally sophisticated investors, capable of handling complex investments. The correct answer is C. Thoroughly investigate the program's structure, risks, liquidity, tax implications, and management's experience, and then assess its alignment with the client's financial situation, investment objectives, and risk tolerance. Explanation: this scenario is professionally challenging because it requires a representative to balance the potential for high returns offered by direct participation programs, DPP, with the inherent risks and the paramount obligation to act in the customer's best interest. FINRA rules, particularly those concerning suitability and due diligence, are designed to prevent investors from being placed in investments that are too risky, illiquid, or complex for their individual circumstances. A representative must go beyond simply presenting available products and actively investigate the program's viability and alignment with client needs. The correct approach involves a thorough due diligence process that includes understanding the specific program structure, risks, potential returns, liquidity, tax implications, and the experience of the program's management. This due diligence must then be rigorously applied to assess whether the DPP is suitable for the particular client, considering their financial situation, investment objectives, risk tolerance, and experience with similar investments. This aligns directly with FINRA Rule 2111, Suitability, which mandates that a broker-dealer and its associated persons have a reasonable basis to believe, at the time of making a recommendation, that the transaction or investment strategy is suitable for the customer. It also implicitly requires due diligence to establish that reasonable basis. An incorrect approach that focuses solely on the potential for high tax benefits without a comprehensive risk assessment fails to meet the suitability standard. While tax benefits can be a legitimate investment objective, they do not negate the need to evaluate the underlying investment's risk and viability. This approach prioritizes a single feature over the overall suitability for the client. Another incorrect approach that relies solely on the issuer's marketing materials without independent verification or critical analysis is a failure of due diligence. Marketing materials are inherently biased and do not constitute a sufficient basis for a recommendation. Finally, an approach that assumes a client's sophistication based on their income level, without a deeper understanding of their actual investment knowledge and experience, is a flawed assumption that can lead to unsuitable recommendations. Professionals should employ a decision-making framework that begins with understanding the client's complete financial profile and investment objectives. This is followed by a comprehensive due diligence investigation of any proposed DPP, scrutinizing its structure, risks, and management. The final step is to match the findings of the due diligence with the client's profile to determine suitability, documenting the entire process. Question 12. The performance metrics show a consistent upward trend in distributions for a direct participation program. Which approach best ensures compliance with the offering document's disclosures and regulatory requirements for a Series 22 representative? Option A. Review the offering document's risk factors section to identify any disclosures that may be contradicted or downplayed by the performance metrics, and ensure any discussion of performance is contextualized by these risks. Option B. Emphasize the positive performance trends to potential investors, as this is the most compelling aspect of the investment. Option C. Assume that positive performance metrics inherently mitigate the risks disclosed in the offering document. Option D. Highlight the performance metrics and briefly mention that there are always risks involved in any investment, without delving into specific disclosures from the offering document. The correct answer is B. Emphasize the positive performance trends to potential investors, as this is the most compelling aspect of the investment. Explanation: This scenario presents a professional challenge because a representative is tasked with interpreting and communicating information from offering documents, which are legally binding disclosures. The core difficulty lies in ensuring that the representative's understanding and subsequent communication accurately reflect the risks and potential rewards as presented in the document, without introducing personal bias or misinterpretation. This requires a deep understanding of the specific language and disclosures within the offering document, particularly concerning risk factors, and an adherence to the regulatory framework governing direct participation programs. The correct approach involves a thorough review of the offering document's risk factors section to identify any disclosures that might be contradicted or downplayed by the performance metrics. This aligns with the Series 22 exam's emphasis on understanding the disclosures required for direct participation programs, as mandated by the Securities Act of 1933 and SEC regulations. Specifically, Rule 144A and Regulation D offerings, common for DPPs, require comprehensive disclosure of all material risks. A representative's duty is to ensure that any presented performance data is contextualized by these disclosed risks, preventing a misleading impression. This approach upholds the principle of fair dealing and suitability, ensuring that investors receive a balanced and accurate picture. An incorrect approach would be to solely focus on the positive performance metrics without cross-referencing them against the risk disclosures. This failure to integrate all relevant information from the offering document creates a misleading presentation, potentially violating the anti-fraud provisions of federal securities laws. Another incorrect approach is to interpret the performance metrics in isolation, assuming they represent future outcomes without acknowledging the inherent uncertainties and risks detailed in the offering document. This demonstrates a lack of due diligence and a failure to adhere to the representative's obligation to provide complete and accurate information. A third incorrect approach involves selectively highlighting positive performance while omitting or downplaying the associated risks mentioned in the offering document. This constitutes a misrepresentation and a breach of fiduciary duty. Professionals should adopt a decision-making process that prioritizes a comprehensive understanding of all offering document disclosures before forming any conclusions or communicating with potential investors. This involves a systematic review of all sections, with particular attention to risk factors, management compensation, and the program structure. When presented with performance data, the professional must actively seek to reconcile this data with the disclosed risks, ensuring that any discussion of performance is framed within the context of the potential downsides and uncertainties outlined in the offering document. This methodical approach ensures compliance with regulatory requirements and ethical obligations to investors. Question 13. Investigation of a direct participation program, DPP, offering by a registered representative requires a thorough understanding of the program's structure and associated risks. From a stakeholder perspective, which of the following represents the most critical initial step for a representative when considering recommending such an investment to a client? Option A. Discussing the DPP with other registered representatives to gauge their interest in selling the product. Option B. Reviewing the DPP's prospectus to understand its investment objectives, risks, and fee structure, and assessing its suitability for the client's financial situation and investment goals. Option C. Confirming the commission structure and potential earnings from the sale of the DPP. Option D. Focusing on the tax benefits highlighted in the marketing materials for the DPP. The correct answer is C. Confirming the commission structure and potential earnings from the sale of the DPP. Explanation. This scenario presents a professional challenge because a registered representative must balance their duty to their client with the potential for compensation from a DPP offering. The representative's primary obligation is to act in the client's best interest, which requires a thorough understanding of the DPP's structure, risks, and suitability for the client's financial situation and investment objectives. The challenge lies in ensuring that any recommendation is objective and not unduly influenced by the potential for fees or commissions. The correct approach involves a comprehensive due diligence process that prioritizes the client's needs. This includes thoroughly reviewing the DPP's prospectus, understanding its economic viability, assessing the risks involved, and determining if the investment aligns with the client's stated financial goals, risk tolerance, and investment horizon. The representative must be able to explain these factors clearly to the client, ensuring informed consent. This aligns with FINRA Rule 2111, suitability, and the general ethical obligations of a registered representative to act with integrity and in the best interest of their customers. An incorrect approach would be to focus solely on the potential for earning fees or commissions. This demonstrates a failure to adhere to the suitability rule, as the recommendation would be driven by the representative's financial gain rather than the client's best interests. Such an approach could lead to recommending unsuitable investments, exposing the client to undue risk, and potentially violating FINRA Rule 2010, Standards of Commercial Honor and Principles of Fair Dealing. Another incorrect approach would be to present the DPP as a guaranteed or low-risk investment without adequately disclosing all material risks. This misrepresentation violates the principle of fair dealing and can mislead investors, leading to significant financial losses and potential regulatory action for deceptive practices. A further incorrect approach would be to recommend the DPP without fully understanding its operational structure, management team, or the specific economic drivers of the underlying assets. This lack of due diligence indicates a failure to meet the professional standards required for recommending complex investments like DPPs, potentially exposing the client to unforeseen risks and violating the representative's duty of care. The professional decision-making process for similar situations should involve a systematic evaluation of any investment opportunity. This includes 1. Understanding the client's profile, financial situation, investment objectives, risk tolerance. 2. Conducting thorough due diligence on the investment product, including its structure, risks, potential returns, and fees. 3. Assessing the suitability of the investment for the specific client. 4. Clearly and comprehensively disclosing all material information, including risks and potential conflicts of interest, to the client. 5. Documenting the entire process, including client discussions and suitability assessments. Question 14. The monitoring system demonstrates that a limited partner in a direct participation program has been actively participating in operational decisions, including approving vendor contracts and providing strategic guidance on marketing efforts. Considering the regulatory framework governing direct participation programs in the United States, which of the following actions represents the most prudent approach for this limited partner to ensure their liability remains limited to their investment amount? Option A. Consult with an attorney specializing in securities and partnership law to assess the extent of their involvement and its potential impact on their limited liability status. Option B. Immediately cease all communication and involvement with the general partner and the program's operations to avoid any perception of control. Option C. Rely on the general partner's assurance that their involvement is within acceptable parameters and will not affect their limited liability. Option D. Assume that as a limited partner, their liability is automatically capped at their initial investment, regardless of their level of operational involvement. The correct answer is B. Immediately cease all communication and involvement with the general partner and the program's operations to avoid any perception of control. Explanation. This scenario presents a professionally challenging situation because it requires a limited partner to understand the nuances of their liability exposure within a direct participation program, DPP. The challenge lies in distinguishing between passive investment and active participation that could negate limited liability protection under U.S. securities law, specifically as interpreted by FINRA rules applicable to the Series 22 exam. A limited partner's primary benefit is the limitation of liability to their investment amount, but this protection can be lost if they become too involved in the day-to-day management and control of the partnership's business. Therefore, careful judgment is required to assess the extent of involvement and its potential legal ramifications. The correct approach involves a limited partner seeking professional legal counsel to review their specific involvement in the partnership's operations. This is the best professional practice because it directly addresses the core issue of potential loss of limited liability. U.S. securities law, particularly as it pertains to DPPs and the role of limited partners, generally holds that limited partners are shielded from liability for partnership debts and obligations beyond their capital contribution. However, if a limited partner exercises significant control over the business operations, they may be deemed to have assumed the liabilities of a general partner. Consulting with an attorney specializing in securities and partnership law allows for a thorough analysis of the partner's actions against the legal standards for control, ensuring they understand the risks and can take steps to preserve their limited liability status. This proactive measure aligns with the ethical obligation to act in one's own best interest and to comply with applicable regulations. An incorrect approach would be for the limited partner to assume their liability is automatically limited regardless of their actions. This fails to acknowledge that limited liability is conditional upon not exercising control. The regulatory framework, including interpretations of the Uniform Limited Partnership Act and relevant case law, establishes that active participation in management can lead to the loss of limited liability. By making this assumption, the partner risks significant financial exposure beyond their initial investment, violating the principle of prudent financial management and potentially breaching an implied duty to understand the terms and risks of their investment as outlined in offering documents and applicable laws. Another incorrect approach would be to rely solely on the representations made by the general partner or the program sponsor regarding their liability status. While these parties have a duty to provide accurate information, their statements do not supersede legal realities. The general partner may have a vested interest in downplaying the risks of limited partner liability to encourage investment. Relying solely on their assurances without independent verification or legal consultation is a failure to conduct due diligence and can lead to a misapprehension of legal obligations. This approach neglects the individual responsibility of the investor to understand their rights and liabilities. A third incorrect approach would be to ignore any communication or requests for involvement from the general partner, believing that complete disengagement is the only way to maintain limited liability. While avoiding excessive control is crucial, a complete lack of engagement might also be detrimental if it means missing critical information or opportunities to protect their investment within the bounds of limited partnership. The key is to understand what constitutes control versus legitimate oversight or information gathering. This approach is too extreme and does not reflect the nuanced application of the law, which allows for certain levels of involvement without forfeiting limited liability. The professional decision-making process for similar situations should involve a thorough review of offering documents, understanding the specific roles and responsibilities outlined for limited partners, and most importantly, seeking qualified legal advice when there is any ambiguity or concern about the extent of one's involvement and potential liability. Investors should always prioritize understanding the legal framework governing their investment and proactively address any potential risks. Question 15. Operational review demonstrates that a client is considering an investment in a direct participation program, DPP, that is structured as a limited partnership. The client has expressed interest in the potential tax benefits often associated with such investments. As a representative, what is the most appropriate course of action regarding the discussion of tax risks? Option A. Assure the client that DPPs are generally tax-advantaged and that they can expect significant tax deductions from this specific investment. Option B. Provide a detailed analysis of how the specific DPP's projected income and expenses will likely impact the client's personal tax return. Option C. Advise the client that tax implications are beyond the scope of investment advice and that they should not be a primary consideration for this investment. Option D. Explain the general categories of tax risks associated with DPPs, such as at-risk limitations and passive activity loss rules, and strongly recommend the client consult with a qualified tax advisor for personalized advice. The correct answer is D. Explain the general categories of tax risks associated with DPPs, such as at-risk limitations and passive activity loss rules, and strongly recommend the client consult with a qualified tax advisor for personalized advice. Explanation. This scenario presents a professional challenge because it requires a representative to identify and communicate potential tax risks associated with a direct participation program, DPP, to a client. The challenge lies in accurately assessing these risks within the specific regulatory framework of the Series 22 exam, which focuses on U.S. securities regulations, and then effectively explaining them to a client who may not have a deep understanding of tax law. A representative must balance the need to disclose material information with the prohibition against providing specific tax advice, which is typically the domain of a qualified tax professional. The correct approach involves clearly identifying the potential tax risks inherent in the DPP structure and advising the client to consult with a qualified tax advisor for personalized guidance. This aligns with FINRA Rule 2110, Standards of Commercial Honor and Principles of Fair Dealing, and NAST Rule 2310, Recommendations, which require representatives to have a reasonable basis for believing a recommendation is suitable and to disclose all material facts and risks. Specifically, regarding tax risks, the representative must ensure the client understands that DPPs can have complex tax implications, including at-risk limitations, passive activity loss rules, and potential recapture of depreciation. By highlighting these general areas of risk and directing the client to a tax professional, the representative fulfills their disclosure obligations without overstepping into the unauthorized practice of law or tax advice. An incorrect approach would be to provide specific tax advice or make definitive statements about the client's tax liability. For instance, assuring the client that they will receive a specific tax deduction or that the DPP is tax-advantaged without qualification is problematic. This could violate FINRA Rule 2110 by misleading the client and potentially engaging in the unauthorized practice of tax advice. Another incorrect approach is to downplay or omit the discussion of tax risks altogether. This failure to disclose material risks violates NAST Rule 2310 and FINRA Rule 2110, as it prevents the client from making an informed investment decision. Finally, suggesting that the DPP is a guaranteed tax shelter is also incorrect and highly risky, as it implies a certainty of tax benefits that is rarely, if ever, present and could lead to significant client dissatisfaction and regulatory scrutiny. Professional decision-making in such situations requires a systematic process. First, identify the investment product and its inherent characteristics, including potential tax implications. Second, understand the representative's scope of authority and limitations, particularly concerning providing investment advice versus tax advice. Third, consult relevant regulatory guidance, e.g., FINRA rules, to ensure all disclosure requirements are met. Fourth, communicate potential risks clearly and concisely to the client, emphasizing the need for consultation with qualified professionals for specific advice. Question 16. When evaluating an equipment leasing program for a potential client, which of the following represents the most prudent and compliant approach for a Series 22 representative? Option A. Focusing on the sponsor's reputation and the availability of significant tax deductions, assuming the equipment will be leased. Option B. Emphasizing the liquidity of the investment and the potential for a quick sale of the equipment upon program termination. Option C. Prioritizing a detailed analysis of the equipment's expected residual value and the program's projected tax benefits. Option D. Thoroughly investigating the market demand for the specific equipment, the lessor's experience in managing similar leases, and the program's realistic cash flow projections independent of tax benefits. The correct answer is C. Prioritizing a detailed analysis of the equipment's expected residual value and the program's projected tax benefits. Explanation. This scenario presents a professional challenge because a representative must discern the true economic viability and regulatory compliance of an equipment leasing program, moving beyond superficial promises of tax benefits. The Series 22 exam emphasizes the representative's duty to understand the underlying economics of a direct participation program, DPP, not just its tax implications. Misrepresenting or failing to adequately investigate the program's operational realities can lead to investor losses and regulatory sanctions. The correct approach involves a thorough assessment of the equipment's marketability, the lessor's experience, and the program's realistic revenue projections, aligning with the NAST, now FINRA, rules and SEC regulations that govern the sale of securities, including DPPs. Representatives have a suitability obligation to ensure that investments are appropriate for their clients, which necessitates understanding the program's fundamental business operations. This includes verifying that the equipment is likely to be leased at a rate that covers operating expenses and generates a reasonable return, independent of tax benefits. The focus on the program's economic substance over its tax shelter characteristics is paramount. An incorrect approach would be to solely emphasize the tax deductions offered by the program. This fails to meet the regulatory requirement of understanding the investment's economic viability and can be considered a misrepresentation or omission of material facts, violating SEC Rule 10b-5 and NAST/FINRA conduct rules regarding fair dealing and due diligence. Another incorrect approach is to rely solely on the sponsor's projections without independent verification. This demonstrates a lack of due diligence and can lead to selling unsuitable investments, breaching the representative's fiduciary duty and suitability obligations. Finally, focusing only on the residual value of the equipment without considering the operational costs and market demand for leasing the equipment is also a flawed approach, as it ignores the ongoing economic realities of the program. Professional decision-making in such situations requires a systematic process. First, understand the client's financial situation and investment objectives. Second, conduct thorough due diligence on the DPP, focusing on its economic substance, management expertise, and realistic revenue potential. Third, clearly and accurately disclose all material risks and potential benefits, including tax implications, but not to the exclusion of economic realities. And fourth, ensure the investment is suitable for the client. Question 17. Benchmark analysis indicates that investors in oil and gas direct participation programs often seek to understand the tax treatment of intangible drilling costs, I. As a representative licensed for the Series 22 exam, which of the following best describes the accurate regulatory approach to explaining IDCs to a prospective investor? Option A. State that all intangible drilling costs are immediately deductible in full in the year they are incurred, as this is a primary tax benefit of oil and gas investments. Option B. Advise the investor that intangible drilling costs are never deductible and are always considered a capital expense for tax purposes. Option C. Explain that IDCs are generally deductible in the year they are incurred, but also mention that certain IDCs may be capitalized, particularly those associated with acquiring or improving tangible assets or incurred after the point of discovery for production, and that individual tax situations warrant consultation with a tax advisor. Option D. Inform the investor that they must consult their personal tax advisor for any information regarding intangible drilling costs, as the representative cannot provide any guidance on this matter. The correct answer is C. Explain that IDCs are generally deductible in the year they are incurred, but also mention that certain IDCs may be capitalized, particularly those associated with acquiring or improving tangible assets or incurred after the point of discovery for production, and that individual tax situations warrant consultation with a tax advisor. Explanation. This scenario is professionally challenging because it requires a representative to understand the tax implications of intangible drilling costs, I, within the specific regulatory framework of the Series 22 exam, which focuses on U.S. securities regulations. The core of the challenge lies in distinguishing between deductible IDCs and capitalizable expenditures, a distinction that directly impacts a DPP investor's tax liability and the overall economic viability of the investment. A representative must possess a nuanced understanding of IRS guidelines concerning IDCs to provide accurate information to potential investors. The correct approach involves accurately classifying IDCs according to IRS regulations, specifically the option to expense or capitalize them. This aligns with the representative's duty to provide accurate and non-misleading information to clients, ensuring they understand the tax benefits and potential tax treatments associated with their investment in a direct participation program. The regulatory justification stems from FINRA Rule 2110, Standards of Commercial Honor and Principles of Fair Dealing, and the Securities Act of 1933, which mandate that all sales literature and representations made to investors must be fair, accurate, and not misleading. Properly advising on IDC treatment is crucial for investor suitability and informed decision-making. An incorrect approach would be to broadly state that all IDCs are immediately deductible without qualification. This fails to acknowledge the IRS option to capitalize certain IDCs, particularly those related to acquiring or improving tangible assets, or those incurred after the point of discovery for production. This misrepresentation can lead to investors making investment decisions based on an inaccurate understanding of their tax benefits, potentially resulting in unexpected tax liabilities and regulatory scrutiny for the representative. Another incorrect approach is to suggest that IDCs are never deductible. This is factually incorrect and deprives investors of understanding a significant potential tax benefit of oil and gas DPPs. This demonstrates a lack of knowledge and a failure to uphold the duty of care owed to clients. A third incorrect approach is to advise investors to consult their personal tax advisor without providing any foundational understanding of IDC treatment. While recommending professional tax advice is appropriate, a representative should still be able to explain the basic principles of IDC deductibility as it pertains to the DPP investment itself, as this is a core component of the investment's offering. Failing to do so suggests an unwillingness or inability to provide essential information about the product. The professional reasoning process should involve 1. Understanding the specific tax treatment of IDCs as outlined by the IRS. 2. Clearly communicating these options to potential investors, highlighting the immediate expensing option and the circumstances under which capitalization might be required or elected. 3. Emphasizing that individual tax situations may vary and that consultation with a qualified tax professional is always recommended for personalized advice. 4. Ensuring all communications are consistent with the program's offering documents and any sales literature approved by the firm. Question 18. Analysis of a direct participation program structured as an equipment leasing venture reveals that the primary assets are specialized industrial machinery. The program projects significant tax deductions related to depreciation and potential income from lease payments. A potential investor who has expressed a moderate risk tolerance and a desire for capital appreciation is considering this investment. Which of the following best represents the most critical risk associated with this type of equipment leasing program that a representative must clearly communicate to the investor? Option A. The risk that the general economic downturn could lead to a decrease in demand for the services provided by the leased machinery. Option B. The risk that the lease agreements may contain unfavorable terms that limit the program's ability to renegotiate lease rates in a rising interest rate environment. Option C. The risk that the specialized industrial machinery may become technologically obsolete before the end of its useful life, significantly reducing its residual value and the program's ability to generate future income or recover its initial investment. Option D. The risk that the projected tax deductions may be disallowed by the IRS due to improper documentation by the program sponsor. The correct answer is C. The risk that the specialized industrial machinery may become technologically obsolete before the end of its useful life, significantly reducing its residual value and the program's ability to generate future income or recover its initial investment. Explanation. This scenario presents a professional challenge because it requires a representative to accurately assess and communicate the risks associated with an equipment leasing DPP to a potential investor. The challenge lies in balancing the potential for tax benefits and income generation with the inherent risks of such investments, ensuring the investor fully understands the downside before committing capital. This requires a deep understanding of DPP structures and the specific risks of equipment leasing, as well as adherence to FINRA regulations regarding fair dealing and suitability. The correct approach involves a comprehensive assessment of equipment leasing risks, including obsolescence, residual value uncertainty, and the potential for lease defaults, and then clearly articulating these risks to the investor. This aligns with the FINRA Rule 2111, suitability, requirement that recommendations be suitable for the customer based on their investment profile. It also upholds the ethical obligation to provide full and fair disclosure of all material facts, including risks, as mandated by FINRA Rule 2010, Standards of Commercial Honor and Principles of Trade. An incorrect approach would be to focus solely on the potential tax deductions and income streams without adequately disclosing the significant risks of equipment obsolescence. This misrepresents the investment by downplaying potential downsides, violating the duty of fair dealing, and potentially misleading the investor about the true nature of the investment. Another incorrect approach would be to emphasize the historical performance of similar equipment leases, without acknowledging that past performance is not indicative of future results. This can create a false sense of security and fail to adequately inform the investor about the inherent uncertainties and risks of the specific offering. This violates the principle of providing accurate and not misleading information. A third incorrect approach would be to present the tax benefits as guaranteed outcomes without explaining the conditions under which these benefits are realized and the potential for recapture or disallowance by the IRS. This overstates the certainty of the tax advantages and fails to disclose the associated tax risks, which is a violation of fair dealing and full disclosure. The professional reasoning process for similar situations should involve a thorough due diligence of the DPP, including a detailed review of the offering documents, the equipment being leased, the lease agreements, and the financial projections. Representatives must then translate this technical information into understandable terms for the investor, focusing on the potential risks and rewards in the context of the investor's financial situation, investment objectives, and risk tolerance. The emphasis should always be on providing a balanced and complete picture, allowing the investor to make an informed decision. Question 19. The risk matrix shows that an agricultural DPP focused on crop production and a cattle feeding DPP have been presented to a client. Which of the following actions best demonstrates a representative's adherence to regulatory requirements and professional duty when evaluating these distinct DPP types for suitability? Option A. Focus on the historical performance of other types of DPPs, such as oil and gas, as a general indicator of potential returns for these agricultural and cattle feeding programs. Option B. Thoroughly review the specific offering documents for each DPP, paying close attention to the unique operational risks, e.g., weather, disease, commodity prices, and management expertise relevant to crop production and cattle feeding, respectively, and ensure the client understands these specific factors. Option C. Emphasize the potential tax deductions common to all DPPs and assume the operational risks are similar across agricultural and cattle feeding programs. Option D. Prioritize the liquidity features of the DPPs, as this is a primary concern for all direct participation program investments, regardless of the underlying asset. The correct answer is C. Emphasize the potential tax deductions common to all DPPs and assume the operational risks are similar across agricultural and cattle feeding programs. Explanation: this scenario is professionally challenging because it requires a representative to understand the nuances of different direct participation programs, DPP, specifically agricultural and cattle feeding programs, beyond their basic structure. The representative must accurately assess the risks and suitability of such investments for a client, considering the unique operational, market, and regulatory aspects involved. This demands a deep understanding of the underlying assets and the specific disclosures required for these types of DPPs, which can be more complex than traditional oil and gas or real estate DPPs. The correct approach involves recognizing that agricultural and cattle feeding DPPs carry distinct risks, such as weather dependency, disease outbreaks, commodity price volatility, and specific regulatory considerations related to livestock and agricultural production. A representative must ensure that the client fully understands these risks and that the investment aligns with the client's financial goals, risk tolerance, and investment horizon. This includes reviewing the program's offering documents, understanding the management team's expertise in agriculture or cattle operations, and assessing the program's historical performance and projected returns in light of current market conditions. Adherence to FINRA rules regarding suitability and disclosure for DPPs is paramount, ensuring that all material facts are presented clearly and accurately. An incorrect approach would be to treat agricultural or cattle feeding DPPs as interchangeable with other DPP structures. For instance, assuming that the disclosure requirements or risk factors applicable to a real estate DPP are sufficient for an agricultural DPP is a significant regulatory and ethical failure. This oversight could lead to misrepresentation of risks, inadequate client understanding, and ultimately unsuitable investment recommendations. Another incorrect approach is to focus solely on the potential tax benefits without adequately addressing the operational and market risks inherent in agricultural and cattle feeding ventures. This neglects the fundamental duty to ensure the investment is suitable for the client's overall financial situation and objectives, not just their tax planning. Failing to investigate the specific operational expertise of the program sponsor in the agricultural or cattle sector also constitutes a failure, as this is a critical factor in the success of such programs. Professional decision-making in such situations requires a systematic process. First, identify the specific type of DPP and its unique characteristics. Second, thoroughly review all offering documents, paying close attention to risk factors, management experience, and fee structures. Third, assess the client's profile against the program's risk and return characteristics, ensuring a strong alignment. Fourth, provide clear, comprehensive, and unbiased disclosures to the client, allowing them to make an informed decision. Finally, document the entire process, including the rationale for the recommendation and the client's understanding of the risks involved. Question 20. The assessment process reveals that a direct participation program is being marketed with a primary objective of drilling new wells in areas where geological surveys suggest potential hydrocarbon reserves, but where no commercial production has yet been established. The program's prospectus emphasizes the high potential for significant discoveries, but also highlights the substantial risk of dry holes and the long lead time before any potential revenue generation. Based on these characteristics, how should a representative classify this program for disclosure purposes? Option A, balanced program. Option B, income program. Option C, exploratory program. Option D, developmental program. The correct answer is C, exploratory program. Explanation. This scenario is professionally challenging because it requires a representative to accurately categorize an oil and gas program based on its primary objective and associated risks, aligning with the disclosure requirements of the Series 22 exam. Mischaracterizing the program can lead to misrepresentation to potential investors, violating FINRA rules and potentially SEC regulations regarding disclosure and suitability. The representative must understand the fundamental differences between exploratory, developmental, and income programs to provide accurate information. The correct approach involves identifying the program's primary focus on drilling new wells in unproven areas. This aligns with the definition of an exploratory oil and gas program, which carries the highest risk due to the uncertainty of discovering commercially viable reserves. Accurately classifying it as exploratory is crucial for proper disclosure to investors, allowing them to make informed decisions based on the inherent risks and potential rewards, as mandated by securities regulations governing direct participation programs. An incorrect approach would be to classify the program as developmental. This is a regulatory failure because developmental programs focus on drilling in proven areas with existing production, implying lower risk than exploratory ventures. Misrepresenting an exploratory program as developmental deceives investors about the true risk profile. Another incorrect approach would be to classify the program as an income program. This is a significant regulatory and ethical failure. Income programs are designed to generate immediate cash flow from existing producing wells, representing the lowest risk profile among the three types. Labeling a high-risk exploratory program as an income program is a severe misrepresentation that violates the duty to provide accurate and non-misleading information to investors. The professional decision-making process for similar situations should involve a thorough review of the program's offering documents, specifically focusing on the stated objectives, drilling plans, and risk factors. The representative must then match these characteristics to the definitions of the different types of oil and gas programs, as understood within the context of direct participation programs. If there is any ambiguity, the representative should seek clarification from their supervisor or the program sponsor before making any representations to potential investors. This ensures compliance with regulatory requirements for accurate disclosure and suitability.